Okay, welcome. This is Tucker Balch at Lucena Research, and today we're concluding the third part of our three-part webinar series, How Lucena Designs Winning Strategies Using Predictive Analytics. And just as a flash forward, a reminder what we're aiming towards, this is the end result of this work that we've been showing you over these last three webinars. Lucena Research is an Atlanta-based company. We're located in the heart of Midtown, right next to Georgia Tech. We are, in fact, a Georgia Tech spinoff. And I'm here today with two of our lead quants, Taylor Korf and Richard Brooks.
Taylor Korf here.
I'm Tucker Balch. I'm a professor at Georgia Tech and also chief scientist here at Lucena. And real excited to show you the stuff we're working on. Now, one thing I wanted to remind you of, you can ask us questions, and please use that feature of GoToMeeting, and we'll pause occasionally to see if there's any questions that you all would like answered, and we'll be glad to answer them as we go along. So again, this is a third webinar in a three-part series. The first part we talked about initial research and data, and in fact we talked about a new data source that we've been collaborating with, Dorsey Wright Associates, and we showed how our machine learning systems could find value in that data, and especially that machine learning was able to discover that other data sources worked great with the Dorsey Wright data. In particular, some fundamental data seemed to really help the Dorsey Wright indicators pop. In the last seminar, we talked about backtesting and how we test and validate the value of a data source. And in this last webinar, which probably take about a half hour, we're going to go through how you deploy a strategy that you've built using our system and how to avoid some of the potential pitfalls there. So like I said, I'm expecting we'll take about 30 minutes, and here's the agenda for today. We're going to recap just briefly 2 slides of how we got here, and then we're going to dive into some of the major questions people have about developing strategies, especially involving machine learning. People are often concerned about overfitting and data mining, and talk about what that is and steps we take to avoid it, and then how to move forward with live deployment of a strategy. Okay, so recapping, on the right there you can see an event study, which we talked about in detail in the first webinar, but that essentially shows you on average over many events the performance of a stock if it satisfies the criteria we're looking for. And we worked with 2 technical indicators provided by Dorsey Wright Associates. It's point and figure change days and point and figure signal indicator. In other words, is it up or down? And then we unleashed our machine learning to see if there were other indicators that synergized with these Dorsey Wright indicators. And indeed, we discovered 2 fundamentals that work together even better than the Dorsey Wright indicators themselves. And we ended up with a backtest looking like this, which looks very strong. And so at that point, now let's consider moving forward with deploying that. So every time we develop a strategy, especially one that looks really great, and we show it to other people, we often get this question, well, how do you know that it's not overfit? And what steps do you take to avoid overfitting? And let me just take a moment to say what does overfitting mean? What it means is that you you may have developed a strategy or a set of criteria for buying stocks that may not actually be discovering real value, but somehow has exploited some aspect of noise or uncertainty in the data. And you run the risk that you've discovered a strategy that works with noise, but not with real underlying value. And the only way that you can ever really know for sure if that strategy you've found does have real value is by trading it going forward into the future. But there are some steps you can take before you even get there to avoid strategies that are likely to be overfit. And here are some best practices we follow. First of all, and one that's really important, is complex strategies, that involve many factors and number of rules uh, are one of the easiest ways to overfit. You want simple strategies that rely on just a few factors and have some simple rules. Complex strategies provide more ways to overfit. Also, if your strategy works well over extended periods of time, it's also less likely to be overfit because it's hard to find a set of factors and thresholds that work in one situation and in another that won't continue to work in the future. So simple strategy works over a long period of time. Another thing to do is just look at the strategy and ask yourself, does it make sense? So a reasonable sanity check there. Finally, and this is what I'm going to step through next, you need to follow a rigorous deployment schedule that helps you avoid overfitting as you go along. And I'll show you what that is right now. So we follow a multi-stage testing and deploying approach. So first step is what we call the in-sample period, and that I'm indicating that here with this red box. And that's a time period where you allow yourself to try different factors and different learning methods and different thresholds and so on. You should expect that whatever strategy you develop in that period should work really well. If it doesn't work well in this in-sample period, it certainly isn't going to work elsewhere. But you should not necessarily expect that just because it works in this in-sample period, that it's going to work later in a different situation. So that's what the out-of-sample period is for. So once we've got something that's working well in sample, and we avoid religiously looking forward into that green box area, we never look there until we sort of freeze our strategy and now allow it to look forward in time, and we test it now going forward over that time. So if you find a strategy that works good in sample, that's not unusual. If you find one that works well in sample and then out of sample, it remains a candidate for potential investing. But that's still not enough. You need to do more checks. And one of the most important ones is forward testing. So what you do at this point is you flip a switch and essentially you paper trade the strategy. You let the strategy look at the market each day, decide what it wants to do. It has no access to future data, so you know that it's not cheating in any way with regard to the data. And you ask it, okay, on this day, what would you do? On the next day, what would you do? And you go forward and see how well it performs under that circumstance. Here is, within QuantDesk, our cloud-based platform, how you can forward test. So this is the screen of our platform that shows the result of a backtest. Well, if you scroll down to the bottom right, there's an option there that lets you create strategy. So after you've refined within QuantDesk the parameters of your strategy and you're happy with it and you want to forward test it, you simply click on Create Strategy. Little dialog box comes up, lets you enter the name of the strategy. You click Save, and boom, it's going. Now, Taylor is one of the people deeply involved in orchestrating all this and making it work behind the scenes. So Taylor, what happens when you click that save button?
Sure, Tucker. Along with the backtesting process, Quant also makes it very easy for you to forward trade strategies. So when you click that button, it's taking the settings from your backtest and all of your training up till that point, and it's creating a strategy out of it. Every morning at 7:30, those strategies are evaluated, and whatever differences or changes need to be made, orders are made from those. And those orders are also summarized and sent to whoever the owner of the portfolio is or the subscriber if it's one of our model portfolios. Come market open, those orders are executed, the portfolios update, and they continue to track forward for performance. And you can actually see intraday updates as well throughout the day, as well as stop loss orders and limit orders are evaluated in intraday.
Okay, yeah, so once you've decided to go with the strategy, it's as simple as clicking that create strategy button and it starts happening. Now, an important next step, oh, you know what, let's pause for a second, see if we've got any questions. So no questions yet. Let me remind everybody, please ask questions. We love to know what you're interested in knowing about. But okay, let's suppose we've been forward testing now and we want to continue to monitor that strategy and know if it's doing well. Well, what does it mean? How can we tell that? Let me step forward there. Our systems have a great feature that allows you to look at the statistics of a strategy after you've crossed over to forward testing or live trading. And that's indicated by this vertical line here when we switched over. Now, what we'd like to see, if things are working properly, is that the statistical performance of the strategy we saw beforehand continues into the future. So what we do, so we create this, we call it a cone, this orange cone. What that reflects is where essentially the error bounds of where we expect the strategy to go in the future if it continued with the statistics it had previously. So we build that cone based on the standard deviation of daily returns and also the mean daily return. Anyways, you can see the expected return there as a diagonal line, and the upper and lower bounds based on standard deviation historical, so before we switched over. You can and here we can see that it's nicely within that expected cone. Now, if you had an extremely volatile strategy that those can also, of course, be profitable, you would see a bigger cone here, so you might allow for larger variation. And one thing to point out here is, if you'll note right here at the beginning, this particular strategy was not performing well, but it was well within these bounds. So we know that as we're going forward there, we shouldn't get worried unless we start exceeding those expected bounds. And you can also look at the results this way. This is the distribution of daily returns, and we look at fitting a Gaussian to it. Probably someone will reasonably ask, how do you know the distribution is Gaussian? Well, it probably isn't, but it provides a nice visualization here. The blue is before we moved into forward testing, and the orange is after forward testing. It's usually the case that the distribution of forward testing returns are actually a little bit broader than the historical ones. And in fact, it often looks like this example where the orange distribution is broader. Now, another thing to notice, and this is a different strategy that did not do well going into forward testing, and in fact, you can see that it's exceeding the expected bounds there. So that's at least, I'm not saying this is the only way, but this is at least one way to check that your strategy is going forward the way it ought to. Okay, looks like we've got a couple questions. Taylor, have you got one you want to take?
Someone asked, how do we decide the lengths of in-sample and out-of-sample data? There's a lot of different strategies you can employ to do training. One strategy that we do is cross-validation. We walk forward and cross-validate. It allows us to have multiple in and out-of-sample ranges so that we can test strategies across time and different periods rather than just having a hard cutoff like you saw in the presentation. It's actually many cutoffs throughout time. That having been said, there's no hard rule, but I think in general we like to keep about 30%, a 70-30 ratio between in and out of sample.
We almost always want to include, the 2008, 2009 time period in our back testing. We'll often hold part of that out, so then we can see how the strategy would have worked during that period. That's a question people always have about any particular strategy. Okay, so those are most of the topics we wanted to touch on. Let me sort of recap these ideas because they are important. Um, Probably the most important thing is when you're developing a strategy, don't start by testing it across all time. You want to have holdout periods. So if you test it, say from 2000 to present, uh, train it during that period, um, you don't know how it would have worked outside the training period. So you always want to have some holdback in time. And typically here we don't look past about 2012 until we found something that works well before then. We'll keep 2012 forward as a holdout time period. Once you find something that works well before 2012, then you can try that out of sample back test. And once you do that, you don't want to change the parameters of your strategy because now you're testing it in conditions that it hasn't been trained on, and the hope is that it'll continue to do well. So now if you have a strategy that does passes both of those steps, it's time to forward test, and we showed you what that looks like. And only after success in forward testing for several months would I consider deploying capital. And once you deploy that capital, you want to continue to monitor, is it performing as the backtest predicted? And when it starts deviating from that, you want to be sure you understand why. And if it does deviate, you might consider taking money off the table, even if it's deviating, say, to the positive side. You want to be able to explain why it's behaving differently. Okay, let's now take any other questions. Taylor, do we have any remaining questions?
We actually had a question about our the forecasting cone, and I answered it privately, but I'll state it here as well. When we're showing that cone that you saw for the out of sample distribution, there you go, Tucker has it pulled up now. Someone asked how we are, what distribution of returns we're assuming. So this is actually, we're extrapolating out standard deviation using a Brownian motion model. That's the answer to the question.
Yeah, so we're looking in this blue area, we are assessing the statistics of that blue area, namely standard deviation of daily returns and average daily return, and that's where the forecast cone comes from. It's not, in this particular case, it's not using machine learning to make that cone. It's just looking at the previous statistics of the strategy. Somebody asks, do we invest actual money in our strategies? Well, for regulatory reasons, strategies that we've licensed to others, we cannot directly invest in ourselves, or we can in a delayed fashion. But the big picture answer is yes, we believe our systems, and we do invest in strategies that arise from our systems that we're not sharing with others. um, but yes, indeed, we think our systems work, and we put our money to it. Okay. Any other question we ought to wrap up with before we wrap up?
One more question. I'm interpreting a little bit here what was asked, but someone asked, how do you look at or what do you do if the in and out of sample distributions are different? Typically, when we're doing our walk forward cross validation, we like to score models or weight models that have similar in and out of sample distributions higher, even if the out of sample, even if we have a model that does very well out of sample but doesn't do well in sample, we're looking for consistency. And obviously, we don't want a model that does well in sample and not well out of sample. So we're looking for models that do consistent performance. I hope that answers the question.
Yeah, consistency is important because it means that your historical performance, the way your model is working historically, corresponds with the way it's working now. So you don't want to see, I mean, of course, it's always fantastic to see it performing better, but that's also a reason perhaps to be suspect. Okay, that's what we wanted to cover today. Thanks very much for everybody showing up and for the questions. And we will also turn this into a video and share it with you online. And if you had any questions about the data or backtesting methodology, and you didn't see the previous seminars, please feel free to go back and take a look at those. Thanks so much, and look forward to seeing you again soon.